Alright, my YouTube friends, some of you might remember that a while ago I had started this going through the weekly S&P 500 chart storm on a video as well, and for a number of reasons I discontinued it, but I've now got a little bit more time on my hands, so I'm going to restart this habit again. So if you're not familiar with the weekly S&P 500 hashtag chart storm, it's something that I do well, my time is Sunday morning, but for a lot of people, especially in America, I think it's their afternoon or evening. And basically I go through either some of my own charts or just some of the charts that I look at on the internet, or even some that I find on Twitter that have been shared by other people in that one, for example. And select 10 of the best or 10 charts that sort of define the current market environment and put some commentary around that. And yeah, we usually get a lot of interest in this. And at the end of it, there is a survey that you can participate in, which I also put the charts up for that every time after that's done. So we can see here. Here goes the equity survey and the bond survey there, and you can tell there that I try to get people to differentiate their view, whether it's bullish or bearish, based on the fundamentals or technicals. All right, that's enough introduction and explanation, I think, so we'll get straight into it. And by the way, this is entirely unscripted, so if there is any ums and ahs, or if it feels like I'm making it up as I go, then that's basically what it is. Alright, so number one here. This one is actually a survey that I conducted earlier in the week. And the question is, what's most likely to come first for the S&P 500 from here? Either 10% up, and at the time that I asked that, it would have been a close at 2,988, or 10% down, a close at 2,445. And the results were just a slight majority in the 10% down first camp, and I guess that lines up with the whole thesis or idea that we might see another dip down before the ultimate return to the upward trend. Or indeed it reflects also some of the bears out there that are particularly gloomy on the outlook. And on to the next one, the Fear and Greed Index. So you can see the link there. If you want to learn more about that, you click the link. I try to put the links on these things. People usually will make comments on them asking what they are, even though I put the links in. So if you're looking at the chart and saying, what is that? If I haven't put the link in there, well, if I have put the link in there, go and check the link first, because that might answer a few of your questions. But anyway, this one's showing extreme greed on the one end and extreme fear on the other, and we're still down in that fear mode. There's a few things driving that, as you can visit that link and find out. But yes, it shows that there is still a bit of fear in the various indicators there, and I typically look at sentiment indicators like this in a contrarian manner. Well, I think they have basically two kinds of information. When they're going through the range, it's more momentum, and when they hit extremes, it's contrarian information. So that would on that sort of frame of mind would be a contrarian bullish signal. Kind of similar sentiment look here. So this is Twitter breadth. It's from this website called tradefollowers.com. They use some sort of algorithm to look at whether the general tweets are bullish or bearish, and you can see there that this is slight upward trend there in bearish stocks, and that tweets on bullish stocks has been it's rolled over, and that's left the overall mood sort of switching more into a bearish phase. And again, I tend to think of that as a contrarian signal, particularly if the rest of conditions are still looking good. So if you're getting a very bearish sentiment scores in the context of improving earnings, for example, which actually we'll be looking at later on in this edition, then that that can tell you a fairly bullish message actually. And on to the next one, another potentially kind of a sentiment or contrarian maybe kind of view is what's going on here in insider transactions. So the red line there is sales, and you can see there that there's been quite a lift in sales by insiders. So I'm not sure what's driving that. I could only speculate and say that they've been looking at what's going on in the market, and they're looking at their stock options have probably gained a lot, or their holdings have gained a lot over the last year, and they're probably thinking, well, I don't want to lose what I've got, so they're probably trying to lock in some of those gains. Either that, or they're aware of something that we're not. It's always hard to tell with this one. Number 5, one of my own, in showing the Implied Correlation Index. Did a separate video on this. If you click onto the top-down charts YouTube channel, you'll be able to find it. It's probably the previous one actually. And anyway, here you can see what looks like a buy signal seems to be lighting up. When I look at this indicator, it's not so much levels that I'm looking at, it's the change. So you can see there's a big spike in correlations. It's shown inverted, so we call that a spike even though it's going down. Just trying to line it up with the index there so that makes the signal more intuitive. And you can see there, during those corrections and during the various sell-offs, you got this sort of spike in correlations or implied correlations when a market bottom was near. And there's a few reasons for that. For example, correlations tend to spike during panic conditions. That whole tendency for correlations to converge to one. In a more macro-driven environment, particularly with the advent of ETFs and popularity of passive funds. An investor holding a passive instrument, they sell that, they sell everything. So it tends to drive correlations towards one across stocks. Number 6, we're over halfway now, so hang in there. We've got here S&P 500 operating earnings, and this is from Urban Caramel. So he's very, very worthwhile follow this one. So if you're on Twitter and you're not following him, that's someone that you definitely want to be adding to your follow list. And what stuck out to me on this one, and by the way, I've put a link to his article there that this chart's from. What stuck out to me from this one is just that surge in earnings from the 2015 earnings recession that we saw. And the dual stock market corrections that we saw in 2015, 2016 were coming off the back of this actual, earnings recession where earnings were actually falling, and now it's quite the opposite situation. And on the sales side of thing, very much, I guess if you're looking at this chart and you see this chart, you probably wouldn't be too surprised. But it is interesting though to note how that's pretty good growth numbers there, and with the base effects, obviously if you're coming out of a recession, or an earnings recession, right, you get this base effect when earnings just normalize, but the base effects are they've come and gone now, and it's actually pretty good growth stats there, and that lines up with some of the other things that I'm seeing across the other work that I'm doing. Number 7, and this is from, no, this is number 8. It was number 7 back there. Charlie Bilello, by the way, is another very good follow. So again, another one to add to your follower list if you are on Twitter. Another good one here is Horan Capital Advisors. I'm probably saying these names wrong, but there they are. If you want to say them differently, then go ahead. The chart is estimated growth of forward earnings. This is year-on-year change in the IBS S&P 500 12-month forward earnings, and what they've pointed out and what I've highlighted here is that The growth rate in forward earnings went from 9.2% in year on year in December to 19.6 in January, and that is basically the tax cuts working their magic. So as you can see in that pre-tax cut period, and as I was highlighting on these two previous charts, there already was a pretty solid trend underway, and there's a few good reasons for that if you look at the economic data, and it's something that we've talked at length about in the institutional work that I've been doing for my clients. And yeah, that's we're basically in the midst of a synchronized global economic upturn. Something a little bit different, number 9. I've sort of commented here, it's a dying breed, seems to be. We've got the percentage of S&P 500 companies with dividend yield greater than 10-year treasury yield. And I'm not sure how up to date this chart is. It looks like it was only up to sort of Q3 last year, but I would say that given what's been going on in treasuries, that figure is probably going to be a lot lower now. Hence my calling it a dying breed. And my base case is that bond yields go up from here even more. So would expect that to further decline. And that sort of brings in the last one into question, sort of try to tie them together if I can. This one shows you, and it's again one of my own, and there's a link there if you want to learn more about bond market seasonality. So on the blue line, it's it's prices for treasuries, and you can see there's this interesting tendency for the January to May period. Bonds tend to sell off during that period, or have weak performance, and equities do the opposite until you get to that sell in May period, where equities tend to taper off and have their worst time in September, October, which is when bonds are starting to do pretty well. It kind of lines up with the economic logic, and of course, seasonality. Again, whenever I cover seasonality, I always make pains to point out that it is only one factor. But if all else is equal, it can be pretty interesting and even decisive factor. So definitely one to think about, have on your radar. And that is it for this edition. If you had any questions, comments, suggestions, yeah, if you even had a submission, a chart idea for a future edition, then get in touch on Twitter. You can see there on Twitter it's at Callum_Thomas, and yeah, it's pretty straightforward. Now I did turn the recording off, but I thought maybe I should just offer a quick couple of words to tie it together. I kind of don't like to try to be forced to tie it together, because then that can have a tendency to limit or force the way I'm putting the chart storm together, because I like it to be just a sort of a mix, or a hot pot of charts. But if you were to tie them together, you look at the first half, and these are all charts that are, that one's showing a bit of bearishness, fear, more bearishness, less bullishness, selling by insiders, the spike in correlations. These are all really indicative of a, predominantly, not exclusively, but predominantly bearish, fearish view. And then you look at that in the context of an existing trend of solid pace of earnings, solid pace of sales growth, and very bullish outlook on earnings. It makes for and then I guess you can also throw in that seasonality chart. You'll still get it's a little bit of a bumpy line, but we still for the most part have positive seasonality through to June. So if I had to guess, I would say up, down, sideways. I'd say up from this point, based on the weight of charts that we have only looked at here. So if you like that little bit of wrapping up at the end, then let me know and I'll continue to do that. Otherwise, stay tuned for the next one.